One of the reoccurring events that shows up every 4 years is a presidential election year cycle. And besides introducing a new decade, the year 2020 is also a presidential election year in the U.S. So in this episode, we're going to examine how stocks have behaved in election years and what it may portend looking ahead. I'm DeLegge with ETFguide. Welcome to the show. It's great to have you with us. Now let's examine two presidential election year trading strategies. So we're going to start with strategy one, which was presented in a 2010 paper titled Presidential Elections and Stock Market Cycles. It was authored by Professor Marshall Nichols at Pepperdine University. He published his data showing a profitable trading strategy that involved buying stocks on October 1st of the second year of a presidential term, and then holding on to those stocks and then selling them on December 31st of year 4 of the presidential cycle. So what type of results did this trading strategy produce? From 1952 all the way to the year 2000, the stock rotation strategy put forth by Marshall produced a peak gain of 70% during the 1976 election year, with the worst gain being a respectable 16% in 1960. Strategy two is to overweight stocks in the best performing years within the presidential cycle itself. According to the Stock Traders Almanac, the most profitable year of the presidential cycle is year 3, followed in order by year 4, year 2, and then year 1. As you know, the year 2020 is the 4th year of the U.S. presidential cycle, making it the second most profitable year for trading stocks. So what does history have to say about this? While analyzing the data, we see positive returns for the S&P 500 index in each of the 23 election years going back to 1928, with the exception of just 4 years which were negative. The negative years, by the way, were in 1932, 1940, 2000, and 2008. In summary, the performance of stocks during the 4th year of the presidential election year cycle has been overwhelmingly bullish and positive. Now, if you're into trading cycles, we only advise trading them when prices are confirming the cycle's historical tendencies. And that same thing and same principle goes for trading seasons. Prices must always and first confirm the season. If they don't, you have no business trading it. And that's a tip on trading cycles courtesy of ETFguide Premium Research. You should become a member if you're not. But to recap, the presidential cycle, historically speaking, has been good to stock traders with a bullish bias. Only 4 election years going back to 1928 have produced negative stock returns. Now keep in mind, no matter how many patterns we find in the data, history is the past, and the future will be different, even though it may sometimes rhyme. So keep your trades on a tight leash and always make sure your portfolio has an adequate margin of safety or cushion for those inevitable road bumps ahead. They will come and they will happen. And be sure to check out our free ETF guides to find out the ETF ticker symbols that you want to own and that you want to trade. Go to etfguide.com/snapshot. That does it for this episode. I'm DeLegge with ETFguide. Thanks for watching.